Intel recently announced its quarterly results and they're really bad. Their revenue went down 22%. Their gross margins went down from 57% to 36.5%. And their earnings per share are minus 11 cents. So that's 109% down. So these results are really bad. But they're only quarterly results. And we as value investors, we have to think in the long term. Bad quarters like that can actually be great possibilities for us. Because usually, and that happened also in this case, the stock goes down really, really fast. Because all the speculators want to get rid of this stock. So that's a moment that value investors can find great bargains. So let's see, is Intel such a company? Okay, so who is investing in Intel right now? What about insider buys? So that's a check. There are some insider buys going on right now in Intel. And what about super investors? That's also a check. There are a number of super investors that are invested in this company. Just to name a few, there's Seth Kalmar, Christopher Davis, Bruce Berkowitz, and David Einhorn. So we can see there is some interest in owning this company right now, but it doesn't mean that we have to rush and buy it. We have to try to analyze it and understand it and then see, is this an investment for us? So let's see the fundamentals of Intel. What about return on invested capital? That's a check. In the last 10 years, it's around 16.2%. So that's really nice. What we are looking for is a return on invested capital over 10%. What about free cash flow growth? That's an X. It's minus 0.5%. So that's a red flag. What about share buyback? That's a check. In the last 10 years, they bought almost 19% of their shares back. So that's really nice, because if we would have invested in this company 10 years ago, right now we would have a bigger part, a bigger chunk of this company without having to buy any extra shares. Okay, what about dividend yield? They are paying a nice dividend of 4.1% on the current price. So that's really nice. And what about the debt? That's an X, because it would take them almost 3.5 years to pay their long-term debt with the current free cash flow that they have. Okay, so let's see the price to earning ratio, which is right now at 7.6. So let's see if we can value this company using the most standard way, price to earnings. If we compare it to a 5-year average PE, that's a check, because the 5-year average PE is actually 13.8. So that's really nice. But then we can do something that Peter Lynch talks about in his great book, One Up on Wall Street, which is finding out the PEGI ratio. So the PEGI ratio is the current PE divided by revenue growth and dividend yield. So first of all, we have to know the revenue growth, and it's for the last 10 years, it's 3.9%, and the dividend yield is currently 4.1. So if we divide P by the revenue growth and dividend yield, that's a check. We end up with 0.95. And what we are looking for is a number below 1, because that would mean that the revenue growth and the dividend yield are worth more than the current price to earnings. So it's nice, but the PEGI ratio is just on the edge. It's really close to 1. So probably the company is getting to a price right now that it can be a buy. But we can do a more thorough valuation using a discounted cash flow formula. And for that, we have to estimate the growth of the company for the next 5 years and then for another 5 years. And we will have 3 scenarios. a low one, a medium, and a high one. So in the low one, for the first 5 years, let's say the company will grow at the rate of 3%, and it will keep on growing at the same rate for another 5 years. Medium, 5% for the first 5 years, and the same for another 5 years. And the high scenario, the one in which we believe that the company is going to do really, really well, let's say 7%, and then 9% from year 6 to year 10. And the valuation that we come up with is almost all red. We can see that only in the high scenario we have a higher price than the current share price, which is 35.39. In all other scenarios, we are in the red. And we also have to remember that the intrinsic value, okay, it's between $23 and $37, but we always have to use a margin of safety. I use a 30% margin of safety. This is crucial because we are estimating the growth. We can be wrong, but if we have a margin of safety, and the bigger one, the better, then even if we are wrong with those estimates, we still have a good chance of making this investment work. So with the margin of safety, we should be looking for a price between $16 and $25 or $26. Right now it's $35, so it's not quite there, but the price is still falling, so who knows? If you believe that this investment can be for you, maybe because of the dividend yield, or maybe because you believe that the company is actually going to grow much faster than I anticipated, then please do your own due diligence. Remember, this is just the valuation that I do, that I believe in, but I'm not a financial advisor. You always should consider what you do with your money. It's your decision, it's your life, so please do not rush into any investment. Take your time, analyze it, understand it, and then make the decision. So thank you very much for today. I hope you enjoyed this video. Maybe you found it helpful. If so, then please like it and please subscribe if you want to see more videos. Thank you very much. Bye-bye.